Hi, this is now coming up with the budget 2022. Let us discuss some of the points about the budget 2022. As such, there are various number of amendments in this budget, and some are of retrospective nature and some are of the prospective nature. We'll take up mainly 10 to 12 budget provisions, including GST, as we can discuss more, but we will not be able to finish in certain time. So let us discuss about the budget for direct tax proposals and then indirect tax proposals. So coming to the direct tax proposals, I have highlighted mainly some major points like tax rates. So we'll discuss about the tax rates, what are the deductions or what are the changes in the tax rates. Then there is a reimbursement of expenses of victim of COVID-19. Then section 43B. Then deduction of expenses of education cess and health cess, expenses which is carried against public policy, cash credit, taxability of VDA, dividend income from a foreign company, and face recipients. And there are certain TDS aspects also that we will discuss. Now let us look at the first one, TDS rates. Friends, this is a welcome aspect of the budget that base rates are not changed at all. The changes are mainly on the surcharge of income tax, and there are two provisions which are of relevance. One, regarding the AOP, where the AOP is composed of only companies, it is proposed to reduce the surcharge to 15%. Second important change is where the income is more than 5 crore, tax is around 37%, as you are aware in the normal provisions today. And there the surcharge was around, the surcharge is now reduced to 15% wherever there is a capital gain short term or long term. Dividend would be, the surcharge on the dividend would be 15% now. That is the second provision in the tax rate. So apart from this, there is no changes. Second is the reimbursement of expenses of victim of COVID-19. If you are aware, in June 2021, there was one circular to clarify that the sum of the payment received by the family of victim will not be taxable, particularly under section 56(2)(10), where any amount received without any consideration is considered to be the income under the other sources. Now, this particular circular has given a statutory recognition in the press notes. This was the press notes with certain changes and the clarification in the budget. So now they told us that on demise, the family received any amount from family or friends, certain amount is not subject to tax, provided the amount is received by a member of the family is rupees 10 lakhs. So other than the employer, if you are receiving any money, the amount of rupees 10 lakhs, up to the amount of rupees 10 lakhs, it is tax free and then it is taxable. Now we are not told that whether if somebody receives 11 lakh rupees, so whether 1 lakh is taxable or 10 lakhs or 11 lakhs is taxable. That is yet to, we are awaiting the clarification. Second, we are told that the amount received from the employer, the same is not subject to tax, and the amount, the limit is not given. But there is a rider here in both the cases, provided that the same should be received within 12 months of the demise of the person. And the demise should be because of the COVID. So we need to produce the COVID certificate, etc. to the department. Third is section 43B. As you know, section 43B is of a cyclical nature. The moment you make the payment, then it will be allowed. And if you make the provision, it is not allowed. So high interest payable to banks, profession, provident fund, or ESIC, such expenses, or you pay interest to the bank, it is not available to set off, or you cannot get a deduction on the provision basis, but you have to make the payment of it. So they came out with the provision that it will be allowed only on the payment basis, that we all know. In various judgments where people were providing the interest and then the interest component were merged with the loan component and showing in the books of account as a paid, and they were taking the deduction from the tax computation. So, Supreme Court noted that in the case of technology, some of the lenders have converted the deferred interest into a second loan. So, and then this is in the nature of the, and like they have abused the provisions, and the currently they say that where there is a conversion of outstanding interest into a loan or borrowing, then it is considered or deemed that it is not paid, and hence it will not be allowed under section 43B. So what are the developments or the amendments in the, because of this particular case of technology, that outstanding interest is converted into a debenture, whether this conversion is not into another loan and it is into a debenture. The Supreme Court took a view that look at the manner in which the conversion taken place. Debenture have been issued in lieu of the interest. Interest now cessation of a liability. So now there is no liability. Recipient of an income has shown as an income in his assessment. So books of account, it is shown that it is paid. So to avoid all such things, they said that even though it is converted into a second loan, then also it is not available as a deduction. Then the fourth one is deduction of expenses of education, sales, and health. So in that particular thing, as you know that the deduction of education sales and health sales is not allowed, right? The various high courts and various courts has taken a view that this is not a part of a tax. So various assessee has taken a view that it is not a part of a tax. As we all know that tax is not an allowable expenditure. Even for that matter, surcharge is also not an allowable expenditure. Sales is a component of income tax or a part of the income tax, or it could be a differential and part of the income tax or not a part of the income. So that is the controversy. And now to remove that controversy, because various courts have taken a various views. High courts have taken a view that it is not allowed. Amendment is made retrospectively now. Some benefit will be there on account of this to the taxpayers. Because if you are taking as a deduction and you are going for appeal or courts, then if you lose your stand, then in that case you will have to pay the penalty also. So now because of this particular amendment, the benefit may go to the taxpayers. Like when there is a demand which is arising on account of a retrospective amendment, whenever we have circular under section 119 to say that there could be a waiver of the interest. This particular provision is from the retrospective thing around 2005-6. It will be retrospective. So because of this, if there is any demand is raised, then interest can be waived. So in case of if you are in appeal, something like that, then if you lose on account of this, then the interest will not be a waiver. Here, because the amendment is there, the interest can be waived. Then the next is expenses which is carried against public policy. Mostly this is affected to a pharmaceutical and a healthcare companies. What explanation says that? It says that if there is any expenses incurred by a company, and purpose of that expenses is prohibited by any law, or it is an offense in that particular law, then the expenses will not be allowed as an expenditure. Very strong words it is being given. The purpose should be an offense and prohibited by some law. Over the years, litigation increases. In pharma companies and the healthcare companies, there are certain payments to doctors for promoting the drugs. Payments made in variety of ways, etc. Guidance of doctors association and are not, means the guidelines of the doctors associations are not allowing to doctors on an ethical ground. So in that case, there are cases against and there are cases in favor of a farmer company. Second is that the offense is compounding, then the compounding amount is also not allowed in that particular law. So if the recipient of the amount is bound by any such amount or is bound by any such restriction or regulation or code or law where he is not allowed to take such amount, then in the hands of the payer also the amount will be considered as not an allowable expenses. The after receiving payment will be considered as a perquisites under section 28(4), and whosoever making the payment, they have to pay the TDS at the rate of 10%. That is what they have changed in the budget. Now the sixth one is the cash credit and the borrowing taxability under section 68. This amendment has very big impact onto the particular loans taken by a person or a company. The section 68 we have to read with section 115 BE, according to which tax will be payable at the rate of 60% with surcharge, and to some extent it is going around 78%. Earlier also this provision was there, and this provision is there today also. So now what they came out is the loan taken from anybody, we need to know the source of a source. So source of a source means if A is taking a B from B, loan from B, then it should know that what is the source of B, whether he is taken from C or not. So nature and source of borrowing has to be explained by a borrower. Credit worthiness and identification, and one has to prove the genuineness of a transaction, credit worthiness, and the identity of a lender. Source of a source need to be checked unless and until lender has explained, not the company, the nature and the source of the loan, and explanation is taken from the lender, not from the assessee. The same is not allowed, and that too it is to the satisfaction of the assessing officer. So the amendment now came is that you need to explain the source of a source. Now look at the example for the loan taken from bank. If a company takes a loan from a bank, so is it that the company will have to prove the source of a source? It means the bank will explain from where they got the deposits and out of which they have given a loan, or even to the extent of NBFCs. So this kind of question can be raised or can be argued sometimes. Or they may have to come out with some clarification for the public financial institutions or PSU bank or something like that. The next is taxability of a virtual digital assets or non-fungible tokens, etc. Not concerned with the legality of this particular thing. The finance minister said that the legality is a different thing and the taxability is a different thing. So and they said they are not concerned only with the taxability. There is a transfer of virtual digital assets like non-fungible tokens or cryptocurrencies or something like that. Then stock in trade or maybe capital asset, the surplus would be taxable at the rate of 30% plus surcharge and plus sales. Cost of acquisition only will be allowed as an expenses. So no other cost will be allowed. Any loss incurred, no set off, no carry forward against this income as well as any other income for this particular capital gain transaction. Next is dividend income from a foreign company. Indian domestic company is receiving dividend from a foreign company. Today it is taxed at the rate of 15%. Expenses are not allowed to earn this particular dividend. Now the amendment is from 1/4/2022, dividend will be taxable at full rates to the company. Now limitation of non-deductible of expenses, now it seems goes away under section 57. Deduction except example, interest expenses up to 20% of dividend income will be considered as a deductible expenses. So there are certain changes will come. The guideline will be issued in some time. Next is phaseless assessment scheme. If there is a stage at which tax officer comes to a stage which it is proposing a variation of income which is mentioned in the ITR, then there is a we are entitled to oral submission. It will be on a video conferences basis. So this is also is there. Next is the business reorganization. Business reorganization. Here we need to understand section 170 and 170A, where there are certain mergers or the demergers. Say example, A merges to X, and there are appointed date and the petition filed date, or the after the appointed date it is filed to the court. Court will take some time. So from the appointed date, income or losses will be shifted to the amalgamated or the resultant company. Now the scheme is sanctioned after some time, then both the company will have to revise their income after the court sanctions the scheme for that particular period. There was no specific provision in law as of now. So as of now, the mechanism or the specific provision is not there. So now it is provided that the receiving company will be enabled to revise the return from 6 months from the date of the order of the court. So they can revise the return. Regarding A Limited, which is a demerged company or amalgamating company, till such time commissioner of this company was aware that with the court order, it will be considered as a standalone company. Officer may not be aware that due to court order, amalgamating company is struck off from the portal as a company. So this kind of issues were there. So now it is provided that there can be a revision of the particular income tax return. Next, we go to the updated return. Correction of an error can be done at some cost. It is something says like that any correction of any order will be at some cost. If someone found certain error are made in the ITR, then within 2 years from the end of the assessment year, correct the same and add income. If you missed out some income, for addition, you can add your income at the end of the and correct the return, and then you can file your updated return. Friends, please ensure that it is not a VDI scheme. And wherever certain cases are going on, like search or survey, it is not applicable. Where the assessment is going on, it is not applicable. We cannot file updated return for assessment is where the assessment is going on. Example is 143 notice is issued and updated cannot be filed. Assessment is completed, updated return cannot be filed. Section 143(1) intimation given to the assessee. 143(2) time run out, hence updated ITR can be filed. 143(1) adjustment is made. In such case, can we file updated return? It's a question, and we need to do the recomputation. So if you are filing the updated return within 1 year from the end of the assessment year, then it will be 25% of particular base tax. For example, if you have an income of rupees 1 lakh, then there is a tax of, say, example, 30,000 rupees. So the tax will be, the additional tax will be accordingly we need to compute on that particular tax. If you file updated return after 1 year and within 2 years, then it will be 50% of your tax. So that will be you need to make the payment of the taxes, and then you can file your. So I repeat the example on, say, 1 lakh, the tax, interest and penalty comes to around at the rate of 25%, 30,000 rupees. You need to pay the tax if you are within that particular thing. Now coming to charitable trusts. So in charitable trust, there various changes, but we will see only two or three. One is section 13(1)(c), where it says that if a charitable trust incurs any expenses which is resulting into a benefit or purposes which is unreasonable to a connected party, then the trust will lose the registration or recognition or exemption on its entity. For example, if you appoint an executive employee or CEO or trustee, etc., and you pay him 10 lakh rupees per month, and actually it is only, say, for example, he is eligible for around 6 lakh rupees a month, then the balance amount will be that will be disallowed, and in such a case, the trust will not lose exemption with regard to the entire income, but to the proportion. So the balance amount, the exemption will be, the trust will lose out. So trust will pay certain penalty in first assessment year, whatever the extra payment paid into 100% of the unreasonable amount, and second year it will be a 200% of the unreasonable amount. Second changes is done in section 13(1)(d), where what we have today is, if the trust were to make any investment in section 8 company or shares of any company, then entire of the income of the trust will be taxable. I repeat, and if the trust were to make any investment in section 8 company or the shares of any company, then entirely of the income of the trust will be taxable. Sometimes it is a compulsion to become a shareholder for achieving the CSR activities as of now. So keeping that in mind, now it is informed that when there is an amount of investment made to section company or any other private limited company, or the shares is being purchased, then the amount of investment will not be considered as an exempt amount. Amount of investment will not be considered as an exempt amount. That is the changes they have made. Now we go to the other proposals like TDS. So now TDS on the transfer of the virtual digital assets. So that is 1% on the consideration of the transfer amount, whether cash or in kind. If the cash consideration is not sufficient to meet the liability of TDS, so before releasing the consideration, the buyer has to ensure that the tax has been paid on the transaction. Second is, TDS is not required to be deducted where consideration is payable by a specified person below 50,000 rupees. And in other cases, if the consideration does not exceed the INR 10,000. Now here, who is the specified person? Specified person is nothing but an individual or HUF whose total sales or turnover or gross receipts is not more than 1 crore if you have a business income, or rupees 50 lakhs for the professional income during the preceding previous year in which the VDA is transferred. Now, in case of no PAN, then 20%. In case of PAN but not filed ITR, then it is a 5%. There's another thing, section 14A, which is time and again there are various changes, expenses for earning exempt income. Now, court held that if there is no exempt income, no disallowance of expenses. In this budget, it is proposed that disallowance of the expenses is there whether or not exempt income is accrued or received during the year. So earlier, you may argue that I don't have any exempt income, so the expenses are not allowed. But now it is said that expenses are not allowed as an expenditure, even though you don't have the exempt income. Then we have now we go to some rationalization of the taxation of the trust, where we have discussed some part earlier. How there are some small amendments which they have done in the trust. One is maintenance of books of account. Earlier, there were no provision of the maintenance of the books of account in the Act. So now it is proposed to provide for a maintenance of books of account for the trust. The acquisition of the unutilized income of the trust. Presently, where the trust does not utilize accumulated income within a period of 5 years, then such income is chargeable to the tax in the 6th year. Now they said that it is now proposed to tax the income remaining to be unutilized in the 5th year itself. So it is The end of the fifth year, it would be taxable, whatever is a amount which is not utilized. In order to discourage the misuse of the fund by the trust or the institution, it is proposed to levy penalty at the rate of 100% of such benefit in case of the first violation, and in the case of second violation, 200%. That we have discussed earlier also. The CIT, Commissioner of Income Tax, can cancel the registration of the trust if there is the following violation. One, if here the trust is applied income other than for the object of the trust. Second, if the trust has income from the business and profession which is not incidental to the attainment of the object of the trust. Third, if the trust does not maintain separate books of account in respect of the business income incidental to the object of the trust. Fourth, income or property is not applied for the benefit if the trust is by public diligent trust. And fifth, income or property is applied for the benefit of the particular religious or community or the caste is not applied properly. If it is applied for a particular religion or a community or a caste, so it should be a general. And the last one is activity of the trust is not genuine. So how the CIT can discontinue your charge, this one registration. The another point here is application allowed only on actual payment. Presently the provision requires 85% of the income is to be applied whenever there is a trust. The term application includes expenses accrued. So even though it was accrued, it was allowed. Now it is said that no accrual policy here. You have to, the applied means, now the definition of the applied is changed. They said applied means actual payment for being considered as an application of the income. So this is applicable for the assessment year 22 to 23. If 85% to be calculated, you have to calculate as a paid amount, which is paid actually. Now we come to the extension of the time limits. For commencement of the manufacturing or the production, the last date by which the new domestic manufacturing company opting for lower rate of tax 15% is changed from 23 to 2024 March 31st. For eligible startups, again, it was startup up to 2022 was allowed, and it is now changed to 31st March 2023. So the startups, the profit eligibility for 3 consecutive years non-taxability is now extended up to the startup which can date of incorporation is up to 31st March 2023. They all can get the benefit of the 3 consecutive year non-taxability of the income. TDS we have already discussed on certain part. Certain part, if it is missed out, like 194R, where benefit or the purposes of business or profession, where this is new section is inserted, where person carrying business profession is required to deduct TDS and the 10% of the value of benefit or perquisites provided to a resident before releasing such benefit or the perquisites. It does not apply if to an individual or HUF if their sales or turnover of the gross is more than 1 crore for business and 50 lakhs for the profession. This is applicable from 1st July 2022. And second is on purchase of immovable property, TDS at the rate of 1% is deductible if consideration paid is 50 lakhs. This is the provision now. Now it is proposed to deduct TDS at 1% of the stamp duty value or consideration. So earlier there were only consideration. Now it is stamp duty value or consideration, whichever is higher. And this TDS provision is applicable from 1st April 2022. Now we come to the some part of the GST. So in GST, there are certain changes. One is additional condition for claiming ITC. So those additional conditions for claiming ITC are: one, that auto-generated statement on GST portal, which will prescribe the manner and condition and restriction I repeat, restriction for claiming ITC on inward supplies. You have to follow the auto-populated statement. Taxpayer will be eligible to claim credit of input tax only if such credit is restricted in auto-generated statements. Again, they have restricted. Third one is, in case of ITC availed in respect of inward supplies where tax has not been paid by the supplier, the recipient availing such credit should reverse the same along with the applicable interest. So 18% they have to reverse. And the fourth one is, the recipient shall be entitled to re-avail the credit so reverse on the payment of tax by the supplier. So if supplier makes the payment later, then you can take the particular ITC later. Now, extension of time limits for availing ITC. Earlier, you have to file the return GSTR 3B for the month of September. Now, it is proposed to extend till 30th November. So, you can take your ITC till 30th November of from the financial year. So, for example, for 31st March 2022, you can claim ITC up to the 30th November 2022. Time limit to issue a credit note also is extended from September to November, and extension of time limit to rectify the errors or omission in the return. So it is now extended to November from September. Following the end of the said financial year, the return included are GSTR 1 and 3B and GSTR 8. This is mainly for the e-commerce operators. Furnishing of returns. In GST, presently taxpayer is not entitled to furnish return, that is GSTR 3B, if he has not furnished such return for any previous tax period. Now it is proposed that he will not be allowed to file if he has not filed GSTR 3B for the previous tax period or GSTR 1 for the same tax period. So it is now more stringent. Levy of late fees for the delayed filing of the TCS return. Now it is proposed to levy late fees for delayed filing of return, that is Form GSTR 7, in respect of tax collected at source by e-commerce operators on supplies, of course, made through it. Interest in respect of the ITC wrongly availed and utilized. So presently it is 24% on per annum on the wrong availment of ITC, even if it is not utilized. I repeat, even if it is not utilized. Now it is proposed that from 1st July 2022, 18% on ITC only when such credit is wrongly availed and utilized. So they have merged these two words, availed and utilized. There's no recovery now. So the meaning of this is there should not be any recovery of interest in case of unutilized ITC is reversed. So this is what, friends, I would like to say on the budget provisions. And thank you very much. Stay tuned on my YouTube video for more updates on taxation, on the management topics, and certain aspect of the financials, transactions, or financial planning, or insurance planning, or any kind of accounting treatments. Thank you very much.